Good morning. It is Monday around 11:30 a.m. Eastern Time. Happy Martin Luther King Day. This is Lumida Non-Consensus Investing, where we identify the big trends and unpack what's happening. Excited to be with you here today. I just got back from a weekend with my brother and my cousin. My brother is about 14 years younger than me. He's getting married in a few months. So we had a pretty mild bachelor party in Middleburg, Virginia. Had a lot of hiking in nature. We're in a cabin in the woods. We had fireplaces. We played Monopoly multiple times, which is kind of amazing. It's a sign of maturity if you can play Monopoly with a family member and come out the better for it. A lot of good food was had. A couple of interesting observations. He's a resident in medical program. He shared that he's one of 10 people in his cohort of guys, and of the 10, only 2 are getting married or in a relationship. He's one of the 2, and of the 2, only 1 is planning to have kids. Okay, these are the demographic changes that we see around the world. Other parts of the world are more accelerated than we are, like South Korea or China or Japan, but it's happening here too. It's happening here also, right? It's interesting when you think about issues like the housing shortage. Of course, today there is a major issue with housing affordability on the one hand. On the other hand, if you measure out housing demand 10, 15 years from now, it's not clear you're going to actually have a housing shortage. We just don't have the same level of household formation and growth in families, which is unfortunate, right? So wanted to share that with you. 2, I want to read from a small passage from this book, Letters from J.D. Rockefeller to his son. I think it's important to defend entrepreneurship and capitalism. Here we go. This is from letter 26. Starts, only when you can endure what people cannot, can you then do what people cannot do. I'll read that again. Only when you can endure what people cannot, can you then do what people cannot do. Goes on to say, conformity is the enemy of thought and the jailer of freedom. Conformity is the enemy of thought and the jailer of freedom. The biggest irony of capitalism is that there's never been a more successful diversity, equity, inclusion program than capitalism. Conformity is the enemy of thought. Is that not true? If you want to find the opportunity, you've got to find the underserved niche. You've got to meet the customer where they are. You've got to deliver a valuable product and service and meet them. Offer that. And when I look around the United States, what I see is the rise of economic populism. It doesn't matter whether it's on the left or whether it's on the right. They're just different forms of government, right? That's what it is. And in the last few weeks, we've seen that from Trump. Now, I do believe this concept of Trump derangement syndrome is a legitimate thing. It's kept a lot of people out of the market. They've been incorrectly in cash, thinking the world is ending, and that's been a major mistake. That's been a mistake, okay? That's a real thing. At the same time, we are seeing economic populism. We're seeing policies from Trump that are to the left of Bernie Sanders and Elizabeth Warren. I'll give you a few examples, and I'll trace this out to what this means for stocks, markets, positioning, talk about animal spirits. There's a lot to get through today. Okay? So, one is there's this concept of banning credit card interest rates above 10%. That's a policy that Bernie Sanders, the socialist Bernie Sanders, floated in 2019, and his cap was 15%. Okay, that's a Democrat socialist policy. That's one example of economic populism. Another would be tariffs, right? Tariffs. This is protectionism. This is policy that AOC would gladly endorse, right? Or Mamdani. Tax cuts as wage support rather than incentives for capital formation. Okay, that's a form of economic populism. Stimulus checks. as opposed for incentives for creating and forming capital and business. Buying mortgage-backed securities, right? The claim that we need to buy $200 billion of mortgage-backed securities, which would do a great job in lowering mortgage rates temporarily, but would accelerate house price inflation. So if you can time it right, you'll do well, but most people can't time it right, and the next generation gets locked out of housing. So that's more economic populism. Price controls on pharmaceutical companies. Price controls are economic populism. So the main consequence of economic populism is that you create more risks of inflation, and it creates more class competition. So I don't like it. I'm not a fan of it. I think the world needs more entrepreneurship, needs more cooperation. The name for that's called capitalism. So by the way, I've been doing more of these FSD streams. So if you're following me on Twitter, you can follow there. We're also trying to cut them up and put them on TikTok and Instagram. Just look up Ram Lumida Wealth or look up Lumida Wealth. They're actually different content streams. So that way I can give you more real-time perspective. Almost every day I'm doing these during the week. So it'll give you a more real-time pulse what's going on. And then we'll have the podcast to kind of synthesize things. And obviously we have our weekly newsletter called the Lumida Ledger, which goes out every Sunday at 11 a.m. Eastern time. So just a reminder, make sure you're following those if that is helpful. So, if you take a step back, look what's happening around the world. You've got Carney cutting deals with China, Carney cutting deals with Qatar, okay? The US and Canada has had a long-standing trade relationship around autos. And ever since this trade war of last year, you're seeing a reconfiguration in how countries engage in trade. And what it's led to is the rise of international stocks. And international stocks are running circles around the S&P 500. That's true for South Korea, Mexico, Brazil, Canada, Germany, the United Kingdom, China, which is a direct object of tariffs, and I think China needs tariffs for reasons that go beyond trade, Vietnam, even France. All of these countries' stock markets are outrunning the S&P 500 over the last 12 months. Let me walk you through some numbers to make that tangible. Not outrunning by a little, but outrunning by a lot. And I don't see any reason why that would not continue. In fact, you're seeing an acceleration of this. So let's go through a few markets today. I'm going to share my screen here so you can take a look at what I'm seeing here, okay? So let's take a look at Spain. I like Spain. Spain's got a great macro story. The index in Spain is up 77% in 1 year's time. Okay, let's compare that to the S&P 500. The S&P 500 is up 18%. That's a big difference. Some of that's driven by the depreciation of the dollar, but that only explains maybe like 15%-ish or so. Okay, then within Spain, you've got banks like Santander. We're long Santander and Spain, by the way. You've got banks like Santander, which are up even more, substantially more. Okay, up 125% in the last 12 months. And this story is true for other markets around the world. Here's Greece. Take a look at Greece. We own Greece. Greece is up 82% in the last year, again, versus the S&P of 18%. We like the banks in Greece too. Alpha Bank is an interesting one. Let's go pull up Alpha Bank. I think this one's in local currency terms, in Greece terms. That's up 135%. Okay, let's take a look at China. How about China? China is up 35%. That's about double the pace of the S&P 500. Again, remember, China is a direct object of U.S. tariffs. How about Vietnam? It's hard to find the Vietnam index. Brazil, Mexico up 62%, clearly a beneficiary of the trade war as you get more friendshoring. Brazil up 50% in the last 12 months. 50% in the last 12 months, again, versus the S&P. So what's happened here is a few things. One is international money managers said, we don't know what's going on over there. Why don't we invest locally? We see that with how the US 10-year bond has no longer become the safety trade. It used to be the case that people would buy the 10-year and during a flight to safety, and you'd see the 10-year rates come down. Instead, now the flight to safety is gold. Gold is being bid up as we speak right now as S&P futures go down because gold has now become the safety trade. So you're seeing these changes in behavior, and they're not one-off. They're consistent and persistent and pervasive, right? That's a change in markets. So we want to identify that, acknowledge that. Then you want to ask yourself, is that going to persist? So what are the drivers of that? Well, policy is one. We talked through some of that earlier. Europe has been courting China to do trade deals. Obviously, Europe isn't happy about Greenland, and that's in this whole mix of things too. And I think continued economic populism. Now, I'm not commenting on the merits of these policies. I'm just saying that this is just the fact, and this is causality, and that's how causality is running. Okay. Here's another fun fact. When emerging markets outrun the S&P 500 in a given year, like they did last year, by the way, it wasn't just emerging markets, it was emerging markets and developed international markets. They both ran over the United States, right? Then it continues to happen in the subsequent years. So in the 2000s, we saw emerging markets outrun the United States. That was in the aftermath of the dot-com bust. So you saw a significant rotation from the United States to rest of the world, especially emerging markets. And really, emerging markets are the exact opposite of like the QQQ in almost every definition, right? Emerging markets are kind of the equivalent of like small cap value, which is another way of being the opposite of large cap growth. So let's take a look at large cap growth. What are the forces acting on large cap growth? One, again, economic populism. How is that felt? It's felt in, hey, if you're a mega cap tech company, you got to pay utility bills. The American consumer will not pay those utility bills, right? Never mind that these mega cap tech companies do have private contracts with independent power producers, like what Amazon has with Talon Energy, or what Microsoft's spinning up with Constellation Energy and trying to reactivate 3 Mile Island, or the fact that sometimes data centers can reduce energy costs. I say sometimes, not all the time. In fact, not most of the time, but sometimes they can reduce the cost of energy in an area if utility has excess energy, right? If that excess energy is consumed by a hyperscaler, then that incremental revenue can offset the fixed costs and lower the average cost of power for the community, right? So you got populist pressure on that. You've got, and if you're an international money manager and you're trying to rotate away from the S&P and QQQ, well, what are the primary components of that? Well, it's Mag 7 stocks. And if you add to that pressure on financials with talk about, getting back at Jamie Dimon because he canceled you, again, that's legitimate, by the way. There was a lot of cancels that banks did during choke point 2. It's legitimate, okay? It's legitimate. But if you also say credit cards should be capped at 10%, then the marginal information is negative to those asset classes. Now you add up financials, you add up mega cap tech, you add pharma stocks to that. What percentage of the S&P are we talking about now? At least 50%. While you have elevated valuations and positionings come around to fully invested, right? Everyone has now got on board with Goldilocks. Everyone is on board with Goldilocks. We just saw a 5% GDP print, nominal GDP print, which is strong. That's a hot economy. We're outgrowing China. China used to grow at that rate. We're outgrowing most economies in the world. And the Fed cut rates despite that. They cut rates not knowing that the GDP was growing at 5%. That data showed up. They cut rates. Again, that creates the potential for inflationary outcomes. If you look out like 12 months, I don't think that's going to happen in the near term. I don't think it happens 1 month from now. I don't think it happens 1 quarter from now. But you do have more fiscal spending. You've got a pressure to cut rates. You will get asset price inflation. That's going to happen. That's going to happen. This has, I think, been the key lesson of the 2010s, and even with the COVID stimulus. Where did inflation show up? It didn't show up in consumer goods because of globalization and the forces of competition. Where it showed up was in asset price inflation. It showed up in the increased prices of houses, and it showed up in the increased prices of stocks. And if you're part of that, congratulations. If you own real assets, you're doing it the right way. Overall, that's the right way to position. But if you're not an investor, then you are on the wrong side of this K-shaped economy. That's the issue. And that's going to create a lot more, I think, social tension and fuel yet more economic populism in a cycle that's not healthy. Okay. So that's the broader trend of things. Overall, like, the economy is strong. The economy is strong. You got strong nominal GDP growth, and we are in a run it hot mode. But the economy is not the same thing as the stock market. Okay. These are different things. So a lot of what I'm saying here relates to how you position around risk assets. And I think that's the kind of the main focus topic we'll get in today. One of the main takeaways is I hope you own international stocks. I have something like 30% of our portfolio in international names now. Every day I ask myself, why don't I own more? If I have high conviction in this, why don't I own more? Okay. If I own a US bank, why don't I own an international bank? They're cheaper, they have more momentum, and they have less policy risk. And you've got good macro stories in other parts of the world too, right? That's just one example. So let's shift gears now. Let's talk about the U.S. consumer. The consumer is strong, right? You're seeing that show up now in retail stocks. You've seen that in recovery in restaurant stocks. One of the ironic things about this massive housing affordability issue is that consumers took what they would have put in a down payment and they spent it on other stuff, especially services, restaurant services, healthcare services, other services. So the U.S. consumer is strong. Every quarter, our analyst team goes through bank earnings, and the bank earnings are a far more insightful perspective on what's happening in the economy than what these economists say, or these forecasts say, or what these Fed officials say, or even what the unemployment report says. Just look at the bank earnings transcripts. Listen to what the bank CEOs are saying. I'm going to walk you through that. Now, we wrote this in the Lumida Ledger, so you want the detailed breakdown, take a look. We do this every quarter. This is our cheat code for reading the economy, and we've been correct and accurate on the economy. When people have been talking about there was a recession on the economy coming, we've said no. And here's a big part of why that's the case. So first off, banks have record earnings. Here's Bank of America CEO Brian Moynihan, quote, "It was a pretty good environment as we move through the year 2025. Unemployment in the labor market is stable. When you go to our corporate commercial customers, they had a pretty good year and good profits, including good credit quality and good money movement." This is Morgan Stanley CEO Ted Pick. In 2025, the U.S. economy proved resilient as ever. As predicted, the capital markets are kicking in with the well-capitalized corporates and high-end consumers driving the economy forward. Two good points there. One is it is a K-shaped economy, always has been, always was. Okay, but the top 20% drive something like 50% of spending, if not more. That's what matters, and that spending is happening, and that cohort has record balance sheets. You got the S&P around all-time highs and record home equity, and they have access to credit, and credit's performing. So that's a good consumer story. Citi Quote, turning to macro, the global economy has powered through many shocks over the past few years, creating optimism and confidence that economic growth is poised to continue. With inflation now at normal levels globally, almost every central bank is becoming more accommodating. Is that not a bull point for emerging markets and international stocks? Capital investment remains strong, especially in tech, and it's a combination of that capex, the health of the consumer, the tax bill benefits, and anticipated rate cuts that should be enough to sustain growth. All that's true. So this is run at hot mode. It's very hard to see a world where you get any kind of recession. I mean, the fact that this economy can shake off so much kind of trauma that's hitting it from these policy shocks just tells you just how strong the economy is. Okay, so it's a strong economy. We've had that view, maintain that view. We go on to describe in the ledger, in the newsletter, around the consumer. This is, again, Brian Moynihan, CEO of Bank of America. Quote, consumer spending grew 5% over 2024 levels. Account balances in the consumer business for that broad base of the U.S. consumer were stable through the year. Delinquencies and charge-offs improved in 2025 consumer credit. Okay, it's good news. His CFO goes on to say, quote, so we're still seeing the growth in each of the consumer categories, and that feels like it's in a position where it's likely to continue to grow from here. Wells Fargo touches tens of millions of Americans, just like Bank of America. Quote, consumers continue to be resilient as income growth has generally kept pace with increases in inflation and debt levels. Both credit card and auto losses were lower than a year ago. Branded cards from Citibank, revenue grew 8%, driven by customer spend, borrowing, and new account acquisitions. Okay. Also record trading, record investment banking, record M&A. So it's not just access to credit, but it's also access to capital. Like, what are we missing here? We have all the pillars. And you've got productivity growth. So the economy's fine. Never been a better time to go start a business. Never been a better time to be an entrepreneur. So initial claims coming down. This is a chart. If you're watching via video, initial jobless claims running below 2023 and 2025 levels. Continuing claims also looking pretty good, right? So there's no big labor market displacement from AI. That's not happening. Just the market's refactoring itself. The economy's refactoring itself like it always does. So things are looking pretty good on the economic front. You can see unemployment rates by age group. The real story here is that the youngest cohort, folks that are just graduating from college, their unemployment rates are very high and elevated. That's because university education has lost product market fit. Product market fit means you pay for a service, you get some value from that. And my view is the dismantling of Sallie Mae post-crisis has led to this issue now where students are graduating with a lot of debt. Those skills are not marketable to employers. And that creates resentment for the system, and that drives economic populism, right? We're kind of reaping the seeds that were planted 15 years ago in the aftermath of the financial crisis. Sallie Mae was the country's largest private student lender. Student lending had an underwriting process. You get a loan. If you get a degree that the lender has a reasonable belief that you'll get compensated for. There are many of these degrees out there: STEM, technical skills, veterinarian, legal, paralegal, plumbing, you name it, quite a few skills. And that, Sallie Mae generated billions in profits for their shareholders, generated enormous value for their customers, including for the schools. And now we kind of have this opposite situation where student debt has been socialized and it's $1 trillion problem for the federal government. Whereas before, it really wasn't a problem. There was actually market discipline. Now you've got to unwind that. So a lot of these issues around economic populism we see today, I do think goes back to this misguided decision to cut private student lending and take out market competition. It's unfortunate. It's really a lot of American employers are teaching employees, right? With skills. We have Udemy courses, like sign up for this coursework, and then it's like we have to assume very little from new graduates and just teach them how to think. I've interviewed people where it's like you're just talking to ChatGPT. You ask them a question, you see a GPT response. There's no critical thinking. So that's the real issue in the labor market. It's the new generation. It's AI and the inability to develop some social skills during COVID is hurting that cohort. So there's an opportunity there if you're an entrepreneur and you can help provide tooling and skills for that population. There's a lot in the newsletter here. I'll kind of highlight a few areas here. One is around software, right? So software has really been an interesting part of the market. I've seen a lot of talk around Constellation software. We don't own it, not interested in owning it right now either. I think the lesson around software is that this is really kind of a subpoint in the broader thesis that everyone studied and worshipped at the altar of Warren Buffett. They were trained to identify and invest in quality stocks. Quality stocks got bid up through the roof, and they were set to lag. I actually have a letter from February of this year called The Bubble in Quality Stocks. And I'll share it with you briefly on the screen here. This is in February 9, 2025. And, we talk about names like Costco, which back then had a 56 times PE. And talk about names like Palantir, 200 times PE, Axon, 116 times, MongoDB, 91 times, Atlassian software company, 84 times. Okay. Those are what bubble valuations look like. And what you've seen since then is a lot of these bubbles have burst. Okay. So Team now is a 23 times PE ratio. The stock is down 54% in 1 year. We're almost to a year of that post, right? Axon is up about 9% in a year, still has a 200 times PE ratio. Costco is up 5% for the year, has a 47 times PE ratio. You're earning treasury bills for taking equity risk in this name, right? FICO is down 20%. One of the world's greatest business models. Kind of doesn't matter when you pay up 60 times earnings. This thing is more expensive than Nvidia and not growing earnings as much, right? So, software is interesting. Software was kind of seen in the past as being like the world's ultimate business model. It's all about lifetime value versus CAC. Can you get a LTV to CAC ratio greater than 3? And can you build a business that's run by software, right? The old quote from Mark Andreessen is software is eating the world. High margin business, get an installed customer base, and now you've got the world's greatest business model. So this was the consensus view in 2021. A lot of software stocks were bid up to very high valuations. And then with the rise of AI, then the new narrative was, well, AI is going to destroy software. I actually made this case myself. Twitter, I said, gee, why do you need SaaS when AI can spin up a dashboard with the UX tailored exactly to what you need? Right? Why do you need Salesforce if the AI can deliver the information insight you want for your persona type, whether you're the CEO, the regional sales leader, or the on-the-ground salesperson that needs to see their pipeline, their accounts, and where to focus? AI can do all of that better than this legacy software. Or take a look at, say, Midjourney, right? Midjourney, you can spin up creatives with that, or Sora, or Google's Nano, which lets you do kind of video image creates on the fly. Why do you need Photoshop then, right? So Adobe has been in a bear market, severe bear market, along with virtually kind of every single software stock out there. The Trade Desk, Salesforce, HubSpot, Team, Elastic. Like, what am I missing, right? They're kind of all in a bear market. But I think a lot of this has been overdone now. I think a lot of this is overdone. And as an investor, you've got to be mentally flexible. You can't fall on the sword of ideology. You have to be mentally flexible. Okay? So I think it's time to start looking for opportunities in software. So I'm going to share with you a few charts now. And what these charts will show you is the relationship between sales, revenue, and then the stock prices of these different groups. Let's take a look. This is Team. Now I mentioned Team earlier, right? Team is down 58% over the year. I highlighted as an example bubble and quality stocks. We'll take a look at Team now. This black line here is the share price of Team for those that are watching. That blue line is revenue. Notice revenue keeps stair-stepping higher quarter after quarter after quarter. In fact, the revenue growth expectation for 2026 is 21%, not too shabby. That's the analyst expectation. Okay, in 27, 28, high teens, 18% plus or minus. Let's take a look at Salesforce. Same story. Blue line, revenue keeps stair-stepping higher and higher. Black line is the share price. So the fundamentals are actually strengthening. Salesforce now is at 19 times forward PE. Adobe, how about Adobe? Sales, the blue line, keeps stair-stepping higher and higher. Now, growth rates last year was 10%. It's no longer a high growth stock. The revenue growth expectation next year is 9%, 9%, then 8% in 2028. The black line is a share price. Look at that widening wedge, right? There's a mismatch between price and the fundamentals. How about HubSpot? We own HubSpot. We bought this on Friday, by the way. So HubSpot growing revenue, also around 18%, 19%. And you see sales growing up, and you see the black line, the share price growing down. These are just some samples I picked, but you could tell a similar story for plenty of other software stocks. So there's clearly a mismatch here. Like the narrative isn't true. The narrative that AI is eating SaaS isn't true. You'd see the sales lines declining. That's just not happening. So it turns out switching costs are higher than people think. It doesn't mean that some of these SaaS companies won't be hurt. I do think there's a real possibility of that. And it also doesn't mean that all these software stocks are a bargain. Let me show you an example of one that I think might not be a bargain. By the way, this is a fantastic business too. This is Datadog. If you are a CTO at a startup, you might be using Datadog. Okay, I know my prior startup, we use Datadog. In fact, this is how I learned about these businesses. I talked to my engineers, asked them what software they're using. But they're a security cloud technology tool. And you can see it's gone nowhere. It's down 13% a year. It's still got a valuation of 384 times earnings and 53 times forward PE. If you have grandkids, maybe one day you'll get a return on your principal. It's a fantastic business, but price is what you pay, value is what you get. And relative to other assets, I'd rather own the other ones. That means this one's probably going to remain under pressure. Okay. So they're not bargains everywhere, that's for sure. So it is a bit of a mixed story. It's not like a layup. It's not a layup. And there's some names that have continued to do well, like MongoDB is up 60% in a year. What's interesting about these software stories too, if you look at the transcripts, they are clued into the AI thesis. Not only that, they're investing in it. They're making their tools AI first, AI native. They're actively engaged. It says audio loss. Can you guys hear me? Test, test, test. Okay. I think we're back, yeah? Let me know if there's an audio issue here, but I think we're good. Thank you. It says audio is all good. Continue after that brief intermission. So I think software is an interesting name. I think software is an interesting category to take a look at. How to approach it? Well, let's take a look at the ETF. I think it's important to look at the overall theme. And I'm going to share my screen and show you the software ETF. This is the software ETF. You can see that you've had a waterfall decline. What's notable about this is that the S&P is essentially at all-time highs, but this category is not. And not only is it true for software, but growth stocks are not at all-time highs either. It's value stocks that are all-time highs and small cap stocks. So keep that in mind. Like, the leadership is changing. The leadership is rotating. The leadership has rotated. So there's new leadership in beta. There's new leadership in what factors are working. Okay. So take a look at software. So software, what you've got here is this waterfall decline. This is like a recognition moment. This is the moment where people say, gee, I have this asset, it hasn't performed, it keeps going down. You start to see more panic. And I look at that peak in volume in the last few days. This is getting into panic area and panic territory. Okay. So it means that we're getting closer to the end. I would expect sometime this week that you might get a low and you can initiate a starter position, maybe like a 1/3 position. Okay, I have about a 2% allocation right now. Maybe I can take that up to 8% over the next few weeks, is how I'm thinking about it now, subject to revision based on how the prices unfold and the paths of these securities look like. It really does depend. That's the thing. There is probability and randomness here. But often what you see is this kind of phenomena like you had around the April lows, where you'll get this capitulation, this waterfall decline, nice peak in volume, a rally, and then a retest. That is another entry point right there. When you get that retest, or some evidence of climax selling. So with buyers stepping in, like you see here, you see that with that little wick there, right? You see elevated volume on the bottom. You see that. So these are the things to look for. And it'd be interesting to see which leaders step up first. I would focus on those, which leaders come through first. So this is something that we'll stay on top of and take a look at. Yeah, it's an interesting category. The things to do there, the bear case is that, well, the growth factor isn't working as much, and semis are working really well, and semis and software tend to move into opposition. It's really uncanny, actually, when you look at semiconductors versus software. Let me share with you semiconductors here. Okay, I'm going to share my screen. So if you're trying to get a read on software, you should look at semis. So take a look at semis. So semis are all-time high. In fact, this relationship between semis and software is almost inverse. Semis started to rally since December 17th. And there's some way to overlay both these charts here. This software isn't the best at that, but you can generally see there's like a negative correlation between software and semis. So when semi rolls over, that's probably when software starts to work, and you are seeing semis are starting to rally with less and less volume. So that turn could happen soon, I think sometime this week. That's my best guess. So keep an eye on that category. Quite a few interesting names there, right? What else? I think the other point I want to come back to is you're seeing changes in leadership in the market. Take a look at like Robinhood, for example. Robinhood is down 17% in the past 3 months. It's down 30% from its all-time highs, just as the S&P is around all-time high, right? Okay, this is a stock with a 45 PE ratio now. Had a fantastic year, up 136%. Palantir is another example. The stock is down about 4% in the last 3 months. It's down, we have to do some quick math here. It's down around 20% from its highs, right? So, these are no longer leading. These are no longer leading. It's got a 396 trailing PE ratio. And, we've seen these before, right? You guys remember Kava? Kava was this hot stock, had IPO'd, had an incredible run in 2023. The stock is now down 39%. It's in a bear market. We saw this with Chipotle, Mexican Grill. I wrote about this actually in May of last year, right around the top, which was awesome. Unfortunately, I didn't short it. Wish I had. But Chipotle is down 32% in the last 1 year. Okay, so this was an incredible stock, was a hot stock. It topped off at 67, and I had a low of like 30. It was like 100% return. So, these are just cycles. What's interesting is restaurants are finishing their bear market, or they're trying to get through to the other side of it, right? Restaurants have been in a bear market since May of last year. You see that across all sorts of stocks in the restaurant theme. Pick a restaurant. How about Texas Roadhouse? All right, this one's, Texas Roadhouse actually did pretty well. Okay, that's not so bad. Up 10%, lagged the S&P, but it's not in a bear market. Okay, how about Wingstop? These are starting to turn, right? Up 1% in the course of a year, was in a pretty vicious bear market. If you can see my chart here. About Chili's, we think Chili's is pretty interesting, by the way. It's up 10% in a year, had a pretty nasty bear market the prior year. So restaurants had a bear market, and it seems to be exiting, and software had a bear market, and I think they will be exiting soon. There are a lot of just cycles in themes. Themes work, then they don't work. So when you look at a stock, it's helpful to look at the entire theme. How is the overall theme doing, right? So a good example might be healthcare. Remember healthcare? You had United Health was in a nasty bear market. The canary in the coal mine was CVS, was the first to go the prior year. Then one after another, they all started selling off, going to bear markets. Those are all in bull markets now, aren't they? Let's take a look at United Health as an example. United Health is down 34% year over year, but it's well off the lows. The lows are 238s at 330 now, and it's trying to get higher. We don't own this anymore. We own names like Centene, which have a EV to sales ratio of 0.1. Think about that for a second. EV to sales ratio of 0.1. That looks pretty damn cheap. If they can improve their margins, I think they'll do pretty well. Centene provides Medicare Advantage primarily to U.S. government employees, and the U.S. government doesn't know how to stop spending. So I'm pretty sure that's a good bet. So, yeah, look, I think there are a lot of rotations that are happening. Things that have worked in the past may not necessarily work in the future, right? International stocks are one example of that. Within high beta, I think the leadership is moving from what worked to new categories and new themes. Those include things like defense and space stocks, right? We just had the U.S. government announce an increase in Pentagon defense spending of 50% to a $1.5 trillion ask, up from $1 trillion. Think about that. There's a lot happening there now. I believe the best opportunities, by the way, in defense aren't actually in public markets because they are expensive now. It's actually private markets. It's finding the next Anduril, right? Anduril's and Palmer Luckey's defense startup. I think it's finding the next Anduril, and there are a few of them out there. Small private companies, sub $10 billion valuation. We love that theme. So our Lumida Ventures team is sourcing deals in that area. If you want to get involved, you should check out lumidadeals.com and check it out if you're an accredited investor. But I think the move 2 years ago was investing in like the core we use in the data center infrastructure build. I think now the move is defense tech. It's the U.S. is refactoring its tech stack from these legacy aircraft carrier battle groups, which are vulnerable to hypersonic missiles and to highly attritable warfare versus like drones that you can produce in volume and having FSD guidance on them. Like that's more of the future. That's where the world is going, right? You see that already in the Ukraine-Russia war. You see that with China and Taiwan, right? Taiwan needs modern equipment, and that seems to me like an obvious trend, an obvious theme. But that's where we're looking. What else? So we'll jump back to the Lumida newsletter. See what else we can highlight. I mean, overall, I would say, I do think international names are just a better place to be. Capital goes to where capital is treated best. And, there's a lot of policy uncertainty and volatility, and markets don't like that. It's kind of that simple. So if I have a choice between two assets, I think I'm going to own Santander. I'm pretty sure Spain's going to kind of keep it slow and steady. And, I like South Korea. South Korea's got SK Hynix. SK Hynix is one of the beneficiaries of hardware-based memory. There's no ADR. You can't invest in it directly yet. They're going to launch an ADR soon. They compete with Micron. They're actually more effective than Micron. South Korea is the home of Samsung. They're the home of KB Bank. Let me show you the EWY ETF. This is the South Korean ETF. It's up 110% in the course of the last year. Okay. So, it's starting to go parabolic now. You might want to wait for a pullback, but there are names within here that are pretty interesting. Look at KB Financial Group. KB is a bank, and it's got a forward PE ratio of 8.1 times and a one-year return of 48%. So you got momentum and value, and it's a leading bank there, right? So, why can't that continue? The interesting stories out there, right? There's also Nubank in Brazil. Nubank is up 47% over the last year. It's got a 20 times PE ratio. It's got a good trend and arguably a pretty darn good entry to the day. I like this kind of setup. You can see my screen right here. This pattern, this kind of hammer pattern, means buyers are stepping in at those levels, and you get a nice pattern of higher lows and higher highs. This is classic kind of buy the dip story, and then you might want to take a look at the ETF for Brazil also. You can see Brazil is also in an uptrend, isn't it? So that's good. So anyway, let me know if you have any questions. Okay, what names do you like in Mexico and Brazil? Well, hey, good to see you, Mauricio. Mauricio has been a longtime reader of our newsletter. Great to hear from you. And I will walk you through a few. So here's a name we own in Mexico. So what's the Mexico story? The Mexico story is friendshoring, right? If you're moving production from China, you can move to Mexico. And how do you bet on Mexico and that trend? Well, airports. Airports are quality businesses. They don't have much competition. And one name could be OMAB, ticker OMAB. This is an ADR, and the name is up 50% in the last year. It's an airline. Airport. Forward PE is 15 times, trailing is 18 times. You can see it's had higher valuations in the past. That's good. It means it's not near the kind of the peak. And the free cash yield is around 8%. It's not bad, right? So they're good names out there. There's some Coca-Cola bottlers in Mexico. I don't own them. Interesting thing about Coke and Pepsi and these names, and they're like confectionery products, is the GLP-1s have been hurting their growth. Isn't that interesting? The GLP-1s like Novo Nordisk and Lilly and Wegovy, they've reduced demand for calories and sugary products. How cool is that, by the way? I mean, first off, it's a good thing, number one. Number two, an innovation in one market in pharmaceuticals has a disruptive impact in another market. That's what makes investing fun. Let me do a detour and show you Weight Watchers, by the way. Okay, Weight Watchers was absolutely destroyed by, did this company go bankrupt or something? I don't know. Anyway, it's down and bad things have happened to it. Here's another one, Medifast. This is let me show you this chart. This is someone dealt with a lot of pain with this one. Look at this. This is Medifast. Look at that. This is it's like a double ski black diamond slope, right? So people that say active management doesn't work, I'd say they're wrong. Like if you have critical thinking, you can look at what you own, what they're indexed to, you can make some determinations around them, right? Let's pull up Coke and Pepsi while we're at it. Let's take a look. Pepsi's up 4% for the year. I don't know why I would want to own it here. I mean, it's got a medium-term downtrend, the 200 days sloping down, 18 times forward PE, 28 times trailing. I can buy other assets with a better profile than that, and we've talked about several, right? So I'm not sure I want to own that. You know, a lot of these packaged good companies are in trouble. They just haven't done well. This is General Mills. This thing is down 21% in a year, maker of processed foods. Kind of feel good about that, right? We need less processed foods, don't we? This is probably a good thing, I guess. But, you know, what's interesting about these names, these were considered consumer staples. You know, Warren Buffett, if you look at his holdings, a substantial portion of that are in consumer staples. You know, it's Coke, Dairy Queen. Apple itself is a consumer staple. It's like a utility, right? You pay your bill every month. He likes business models like Gillette. But that hasn't really been working. Let's see. It's a question. You still think that international ETF would just do the job for someone who doesn't have a lot of cash ready? And what ETF would you think is interesting? So I think there are a lot of interesting ETFs you can get exposure to. One is ticker IVLU, stands for International Value. That's one. Maybe GSIB, GSIB. I would like that, except it does have some international banks. Both have done extraordinarily well. Both have beaten the S&P 500. And then there are country ETFs too. There's EWZ in Brazil. There's EWY for South Korea. You know, I'm not a huge fan of France, by the way. I like to make fun of France just because. France has a lot of luxury stocks. I think the high-end consumer doesn't have as much demand for luxury products. They care more about experiences and services, and they care more about travel and leisure. So I think things like Expedia could be interesting for now, right? Where are the baby boomers spending? They're spending on travel and leisure. They're spending on restaurants. They're spending on healthcare. They're spending on cruise lines. Follow the baby boomers. Follow the demographics. The baby boomers, they have the assets. They are spending. What are they spending money on? That's what they're spending money on. I think you could make a pretty good portfolio just following the baby boomers. And no one talks about that, right? But isn't that the obvious thing to do, is go follow the baby boomers? It really is. Let's take a look at Expedia, for example. So this is pretty much near all-time highs, right? It's up 52% in a year. It's up 33% in the last 3 months. I call that out. People wonder, well, Ram, you might be asking, well, why are you talking about what happened in the last year? That happened behind us, past is in future. That's true, except statistically we know that stocks that have momentum tend to continue to exhibit momentum. And momentum has a very specific definition in the world of factor models. Momentum is defined as the return of a stock in the last 12 months minus the most recent 1 month, which is a little kind of confusing, but it's almost like do the opposite of what the most recent month happened. But just keep it simple. What happened in the last 12 months? And if you look at a name like Expedia, and let's take a look at the historical valuation, it's 17 times forward PE. It's not cheap. It's not expensive either. Right? It can rally from here. It's got some good structural tailwinds. We like it better than Booking here, but it's an interesting way to bet on the consumer and the baby boomers. And someone asked me, thoughts on AVAV, since you like the defense tech sector, by reading the newsletter. So I don't know this name. I saw this come up on one of our screens. One of our analysts can take a look at it. I think the best way to play defense tech is in private markets. Public markets is hard, although there are some stocks in private public markets which are interesting. I'll talk about that at a later time. I don't think they're good entries right now. But yeah, there are some public market names where they're kind of interesting. Any other questions? What else? I think, look, if you're looking at other opportunities in private markets or public markets, I would look at like senior living care. Like the demand for that has to increase. There's not enough of that. Look at daycare. Look at, there's got to be some entrepreneur out there focused on education tech. I don't think that's a hard category, but I'd like to see that. Have a nice stream. Thank you. Appreciate it. And yeah, I guess, I'll conclude with kind of the geopolitics. I think the geopolitics just continues this trend of international value outperforming. There's a bit of a realignment happening, and capital flows to where it's treated best, and investors just don't like uncertainty, and momentum attracts its own momentum. So I think that trend will continue. I think value stocks will continue to outperform growth stocks. It's happening now. I don't think that stops. Overall, the economy is great. Their productivity is very strong. This is a Goldilocks economy. The tricky part is just positioning. So it's a Goldilocks economy, but positioning might actually be better internationally, which is kind of funny, but that's just how it is. Anyway, hope you had a lot of fun. Enjoy the long weekend. It's a great day to honor a great American hero in Martin Luther King. The universe bends towards justice, right? Did I get that right? It's like on the long enough time horizon, the universe goes towards justice. I think he's right about that. All right, be well and make it a great one. Until next time, cheers.